All right, since we have very limited time, I could probably do this kind of stuff for days, and you guys aren't here for days. You're here for an hour or so. So I want to make sure that you guys get as much out of this as possible. So let's get to it. So this is what we're going to cover today, guys. You know what? We're going to go over one, how listening to exciting headlines is hurting you. It's not helping you. I know everyone loves to look at the craziest headlines and read the articles, but that's not what's going to make you money. I'm also going to go over why trying to make a big market call is a mistake. We're going to go in the third module and say the reason it's time to treat trading like a business instead of an expensive hobby. Number four, why practice and discipline, actually why patience, practice, and discipline actually don't exist, and what you need to focus on instead. And then five, what's kept me in the business for 20 plus years. Like I said before I started, I've been doing this for 20 years. So what I like to do is I try and make your learning curve as fast as possible by trying to teach you and give you guys everything that I know wrapped up into as limited time as possible. And then at some particular point, you could always expand upon it. That's up to you, and that's your own initiative. So here we go. Let's get going. Number one, looking at news is wrong, and it's hurting you. Okay, online news has completely changed the game. We only hear more about what gets clicks, meaning the craziest headline is what sells. It's not typically what makes you money. What this does is it creates an endless cycle of dramatic headlines that really just don't mean anything. I think this morning on Twitter we were talking about how they were obsessing about Brexit again. We've been hearing about Brexit for 2 years. That's not going to make you money. Just everything has been just sensationalized. From the high frequency trading, Bitcoin. Everyone says how the world's going to end, and it just doesn't. Um, I think Apple made what? It made a new 2019 high today, and all you hear about is lack of demand for iPhones, and we have to worry about the China trade deal. So the headlines and listening to them are not going to make you money. It's really how the names react to those headlines. The bearish argument has always sounded better. It just has. You know why? Because people like to read about, negativity, the end of the world, misery likes company, but chances are those periods are very, very short and very far and few between. The 2008, 2009 crash basically changed everything. Traders are afraid of feeling like they're going to get suckered into the market. This is why we always hear about the doomsday scenarios. If you're even a little optimistic at any point in time, people will call you a permabull. And I've been called a permabull so many different times. I've been called Dr. Doom. I don't know if you guys saw me back in the day when I was on with Mark Haynes, pretty much every other week during the 2008, 2009 crash. The Dow was, I think, what was it, 11,000, and Mark Haynes was calling me Dr. Doom because I said we were at a bottom. And then PS, when we were on the road and trending from S&P, what I said, the road to 1700 or so, I was getting hate mail for being a permabull. But I'm not a permabull. I'm not a doomsday guy. I just try and stick to the trend and know my time frame, which we're going to get into because that's very, very, very important. Okay, we're being trained, and traders are, to be afraid. If you look at Google and you just type in why the stock market, you're not going to see why is it going up, why it could help your 401k, why it can make you cash flow, why it could add money to your life, why it could help get a vacation home. You're going to see why is the stock market down today? Why the stock market crashed? Why the stock market fluctuate? Why the stock market crashed in 1929? Why the stock market will crash? Why the stock market is down? You get my point. It's all counterproductive. It's all so you guys could be fearful, not execute with confidence and really just not be as involved. Let's see will the stock market will the stock market crash in 2019? Not will it trend, and will you have stocks making all-time highs? Will you have leaders? Will the stock market crash? Will the stock market go back up? Will the stock market recover? Basically, again, all very non-constructive headlines where you're basically being trained that the next pull-in isn't a pull-in to buy, it's a pull-in to crash. And obviously there are ways to know whether a pull-in is going to be a 2 to 5% pull-in, or whether it's going to be a 5% pull-in, an 8% pull-in, or more. We get into that in a lot of our courses with our moving average tactical approach. But again, you're being trained to be afraid, not opportunistic. If you look at the big picture of trading, okay, I've posted this also. This is how many times in the past, I don't even know how long. This is what, since March 2010, how many different people have tried to make the most outlandish calls to make a name for themselves and pretty much scare you out of the market. If you read these, some pretty decent sized names, right? You have Harry Dent. This was in 2012. The market will be cut in half, or at least by 30%. Not go down 5, 10% first. Bill Gross. Oh yes, isn't he the bond king? The cult of equity may be dying. I remember that. I remember when he said the cult of equity may be dying. I think we were in a nice trend, making higher lows this entire way up, and he basically said equities were dead when I was on with Jim Cramer. If you if you Google, there was a segment that we did together where it said, when will this, how far will this bull market go? And I outlined an entire scenario and how we're going to break above 1500, go to 1700 plus. But anyway, this is what things get just sensationalized with. Here, Robert again, predicts a 50% unemployment, 90% stock market crash. 90%, okay. Tom DeMark, he's actually pretty good. I like him as a technician. Again, what was this in 2014? It's an important top. It should at least be for 3 months, that top, and then just, it goes on, so on and so forth. So basically, they're just training you to really think the worst and not think clearly. And as a technical trader and strategist, you need to think clearly, have a plan, and follow the trend. Because if you look at this next chart, look how long the bull market cycles last. Okay, what was this? This duration was 13.9 years, and then the bear market was a quick 6 months. That's it, 6 months. This one was 15 years, 6 months. 6 years, 1.6 years. That was a bigger one. Okay, and then let's skip forward to the famous one in 2001, which was the tech bubble bursting. It lasted for 2 years. That's when everyone said investing was dead. Okay, obviously after a 12-year run that had to be consolidated. Then you had another 5-year bull market. I remember that one. That one was great. That was after we invaded Iraq, and it was 2003, I believe, and it was just awesome. I traded right through that one. And then, the big one that's the most recent, in the era of, or the arena of social media, this lasted 1.3 years. By the way, that's all it lasted. 2007 to the 2009 bottom was 1.3 years. And we've been in a bull market for almost 10 years thereafter, whereas every year was supposed to be at the top. So think about how long these bullish trends last with key stocks making highs. So it's so constructive. At least for me, I'm more comfortable as an active bull, but obviously I know when the market's not feeling good, when active trends get broken, when we talk about when we break key moving averages and how lower ones can get tested and how we figure out whether or not we're in a real volatile area versus trending, not looking at the news, not looking at the world ending, trending. And hopefully you have a long-term plan, because that's truly key, especially if it's 20, 30, 40 years. But what we do for a living here is we trade for cash flow. We trade for a living, and I've been doing it for 20 years. You look at your favorite publications, Barron's. Yeah, anyone remember when Barron's put a $15 price target on the front page? I think that week I did a segment with Kramer talking about how I thought it was going to get back to 44 and above, and again got hate mail through the roof. And I think this was the bottom. Not saying Barron's is always like, in the positive it's a top, or bottom, when the negative it's a bottom, or same thing with they say the same thing with the New York Times. It's kind of a contrarian indicator. But anyway, Facebook, the trend has been absolutely unbelievable with so many price patterns and so many chart patterns, if you know chart patterns, which, are all featured in so many of my courses. But, again, Barron's is worth $15. Okay, where is it now? So you can't believe what you read. You have to believe in your tactics, and you have to believe in your system. Remember Brexit? I remember, again, yesterday everything was all about the Brexit again, and meanwhile, look where we are in the S&P. We're at 2019 highs. But anyway, I remember when, all these headlines came out with Brexit. It was like the world was going to end. Brexit is going to totally obliterate everything good in the British economy. Could Brexit vote cause a stock market crash? Brexit could trigger European stock market crash. U.S. stocks hammered. Okay, these were everything that you read about with Brexit. So you're like, oh, you know what? I'm just going to short. And same thing happened with the 2016 elections. Everyone thought that Trump would, cause a market crash. That if Hillary won, we were going to rally, and Trump won, we were going to crash. If you remember that night, election night, I think we were down until about 2 o'clock in the morning, and then all of a sudden we turned, and then we had an unbelievable trend thereafter. So again, you cannot focus on the headlines. You need to focus on the price action. And you need to have a system on how to read the price action, because that is so important. So if you look here, this was the Brexit vote. Oh, world was going to end. This was the 2016 election. Oh no, President Trump is in office. We're going to crash. And we just kept trending along. And right now, this is just a bunch of green and red candlesticks that maybe you know how to read them, maybe you don't. You know, if you take most of my courses and you're part of Redler All Access, you know how to read these and you know how to basically interpret them and make them into money. But for this, that was the Brexit vote that you saw every headline where the world was supposed to end, and that was when Trump won, and obviously we're a heck of a lot higher. So basically, in conclusion, we are in the reacting business to the news. Okay, we're not in the be just basically take the news for what it is. When was the last time we talked about the wealth stocks that I've created? When was the last time they talked about 401ks that are necessary, or 529s for your kids, or the risk of not having a long-term financial plan, or how you could add cash flow to, whether, like, just say you have a job and you think that you could, you have enough time to put in to learn how to find stocks showing relative strength, trading with great chart patterns that you could use a tier system to add cash flow to whatever job you're doing, or to do it full time. There's no articles out there how regular people are making money trading in a calm, calculated manner. It always has to be chaotic. Why even perma bulls, or perma bears could take advantage of a 401k. As I said before, what you need to do with these headlines is know what the market is looking at, so you can see how we react. And we are, again, in the reacting business. News will never help you predict market direction. You can only read the trend and focus on finding actionable setups. Let the chart tell you what matters and what doesn't. You could have a crystal ball for the news and still lose money, meaning someone tells you what's going to happen, whether a company is going to beat on earnings. Sometimes they beat on earnings and they don't go up. Sometimes they miss earnings and they guide lower and they don't go down. You need to read where it came from, where it is now, and you have to use that day's levels and system and tactics in order to figure out whether it's priced in or not. I'd have to say Brexit is the greatest example. You could have known the results beforehand and still lost money by trying to stay short versus reacting to how that day engulfed the bearish action. The second subject matter is, why trying to make a big market call is a mistake. It's fully a mistake. People are out there all day long on Twitter. They're trying to talk about where the market can go, whether it's a huge bullish call or a huge bearish call, or it could be a stock, it could be whatever it is. But if you make a big market call, chances are, you can do everything you can to try not to be wrong, and you're not going to use your stops, and you're not going to honor your system. Big calls sound great, but they don't make you money in trading. I remember when this came out. Remember Dow 36,000? So like trying to call tops and bottoms work great on TV. Maybe they get you back on if you're lucky to be right. It might sell you a book too if you have a good marketer, but it's not making you money. Dow 36,000 was published. That was 1999. Jesus, that was right right before we had the tech bubble burst. The Dow hit 7,200 in 2002. Okay, a little bit off. But anyway, here we are. What year are we in? 2018, and we're not so far away. I would say Dow 36,000 could happen in the next 5 to 8 years, but anyway, that's more conservative. And here we are, the Dow still hasn't crossed 27,000. But anyway, making money along the way, judging the trend, using chart patterns, using a tier system is how you're going to make money, not by making big, bold calls that people think will sell page views and advertising. The trend is where the real money is. Here is the 2017 and early 2018 S&P chart. If you were obsessed with predicting the end, you missed the whole move. This was a beautiful move. We were in a portfolio approach, which I know some of you know about, which is also in our course on when to be in a portfolio approach, when to be in a tactical approach, what moving averages to use. But anyway, everyone was trying to call a top, and then finally, we saw something that gave us a little bit of a clue that we could pull in. But again, this is the trend. That's what we obsess upon, not trying to call a top, not trying to call, a bottom. A big call won't change your life. Most people who are famous for a big call only got one of them right. Then they disappear after the next big call goes wrong. Real traders look to make money day by day. You can wait forever for your big call to work out, but chances are you're going to be breaking all your rules trying to stay involved to back up your big call. I've had many big calls out there. Actually, I was told he wasn't supposed to tell the story, but I think back in 2008, 2009, if you watched, I was on with Mark Haynes. At that point, I was in my career. I wasn't the same size trader I was now, and I came out with the gold bold call. I don't know if you want to Google the gold bold call. I think gold was like trading at like 8.15 ounce, and I told Mark Haynes, because he was sick of my like if this then that, if that then this, which is what traders do using chart patterns and use scenarios. I was like, I think gold's going to $1,500 an ounce. That was in the morning with him with Aaron Burnett, and he laughed at me. And then at 2 o'clock, Aaron Burnett goes to Gartman. I think he's the commodity king, or he was, and I guess he still is. And Aaron Burnett was like, "Hey, we're on with Scott Redler, who's been on for quite some time. He's been very accurate about the market calls, and he says gold's going to $1,500 an ounce." That was my big call, my big claim to fame. Um, and he said, "Well, if Scott Redler's right, he doesn't believe in the American way of life." So it kind of laughed at me. And then I think when we got to 1200 in gold, he changed his call to positive. And me as a trader, I made money at it, but people thought I made millions. People thought I should have retired. But meanwhile, I was a technical trader strategist who put the call out there in the media. Everyone thought I was so smart and so awesome. Meanwhile, I made money, but it wasn't significant. So even my big, bold call doesn't mean I'm making so much money from it. So it's how you navigate your idea and how you use a tier system and how you use your pivots and how you use your process to make money versus the big call, because it's not going to change your life. It might get you a few more followers on Twitter. That's it. And change your mindset. That's what I think got me the most, what's it called, successful, is focus on netting money today, not the world ending tomorrow. Have a plan for squeezing money out of the trend that's in front of you right now, whether it's bull or bear. You can always step aside and get tactical when the trend changes, when you want to figure things out, when markets are going through market discovery. I try not to predict the future, but my system tells me when the trend is changing. So I have to change up my strategy because that's what I do. I trade real time and I focus on netting money every single day, doing the right trade, not the trade that I want. Big calls mean big risk. You rarely hear about perma bears putting money on the line. They just make calls. Big calls on the market require big risk. Remember, the market can go up on bad news. It can go it can go down on good news. So again, the news is not the culprit, it's the reaction to it. Your strategy must protect you against the big drawdowns. You're about to learn why you can't afford that big loss. A secret reason so many traders burn out of the business. This is so true because it's hard to make money when you have to make money. Say that again to yourself. It's hard to make money when you have to make money. When you are down and have to dig yourself out of a hole, you start trading on emotion. You don't start trading on the setups. You don't even know what a good setup looks like because you're trading and you're not thinking straight. You're trading with emotion. This is when you force trades. This is when you try and manufacture situations, maybe take a B or C trade versus an A trade, which is not what you want to do. Your strategy must protect you against big drawdowns because big drawdowns is what could ruin your psyche, could ruin your head, and could have you potentially thrown out of the business. I've seen many traders that swing for the fences at big drawdowns and they can never, never come back. How small losses turn into big ones. Let's say it's been a bad month and you're down 5K. That's probably not a bad month for some of you. Some of you that could be 10K, that could be 15K, it could be 100K. Doesn't matter. It's just a concept. Okay, if you feel like you have to trade to make that money back, it's easy to break your strategy and get restless. What I say is when you're down money, I want you to chip away out of it. If you're down 5K and that's a lot of money to you, you know what? Make $500 one day. Make $500 the next day. You start feeling better. Then you make 1,000. Get green. You work it back. You're not trying to make back $5,000 in a day if that's a big down month for you. If you're down $20,000 or $30,000 in a month, you're not trying to make that back in a day. You're trying to chip away at it. You're not swinging for the fences, because that's how you get into a deeper hole, and that's when all of a sudden you can't get back. So this is why I aim to make as much as I can when the market is also trending, because you ever heard the phrase, you got to strike while the market, strike while the iron's hot, or strike when the iron's hot again, is because when the trade is there, you have to maximize it. When something breaks out a great pattern that's tight, that's a name that's a quality name showing relative strength, you got to make sure you're in a tier 3. You might not know what a tier 3 is now, but you would, or you will down the road. We use a tier system: tier 1, tier 2, tier 3. So when the market's trending, you got to make sure you make your money while it's trending, not when it's in a market discovery time, or not when you're in a hole, because you're not going to see things clearly. You don't want to get backed up into a corner, feeling like you have to fight your way out. If you're feeling like you need to fight your way out, and you're feeling confused and you're feeling reckless, take the day off, because you're only going to lose more money. You're only going to add to whatever a big down month is for you. What you want to do is just get green. When all things go wrong, you get green. Okay, that's how you get yourself out of a corner. You make a little bit of money, make a little bit more money, you feel good. Then all of a sudden you start seeing things clearer, you start making better decisions. Then all of a sudden you start making more money back, and then before you turn around, you're positive, and then you can start building all over again. So the key is netting money always. Net money. Don't turn a big down day or a small down day into a big down day. Don't turn a big up day into a down day. If you give money back and you start to lose control, just end your day. Net money. It adds up. You got to take the market day by day and execute on your plan. This is why I focus on constant trend analysis. I want to be netting money every day as long as I possibly can. That makes me risk averse. So again, I like to be a singles hitter. I'm not looking for a double, triple, or home run. I'm looking for quality setups that are consistent, that I can net money. Yes, I'd love to hold something for 3 days, which is usually the max of my day count. But sometimes it's a day and a quarter, sometimes it's a day and a half, sometimes it's just the first half hour. But I constantly am looking to the trend to analyze it, so this way I can net money, and I do it day by day. Sometimes you could stay with something for weeks and months if the trend is strong, and that's how you maximize it. You build your account up, and you can survive the short-term troubles. Another subject that I think traders have a hard time with is, what I say to them is, don't treat trading like an expensive hobby. It's a job. It's not an expensive hobby. Why you must treat trading like a business. Why hobbyists fail to make money. They are in it for the thrills instead of to make money. Excitement does not justify your losses. Some people like to buy into an earnings play. It's a flip of a coin. Yes, something could be up $40 or down $40, and if you happen to be up $40 a time, a Netflix or an Amazon comes out with earnings and you make, and it's great and it feels good, it's a guess. You don't make money by guessing long term. Okay, what I do sometimes, which I talk about in my course, is I take options because risk is premium paid, or I trade afterwards, and I use pivots, which is also another subject matter I go over in a lot of my courses. But the bottom line is, I don't look for thrills. I look for consistent ways to limit my risk so I can net money. The thrill seekers are actually surprised. Oh, I made money in this. I have more money to put on the line to lose. No, your job is a business, and your business is to net money, and hobbyists fail to make money. Making money should be just another day at the office for you, so you can get paid and it could add up. How pros are different. A few things set the best pros apart. They want day by day cash flow, not win by accident once a month. Meaning singles 4 out of 5 days are much better than hitting a home run twice a month. You want to be consistent. What pros do? They focus on A setups and they ride the trend. And they don't care about being right. They like the right setup, whether it agrees with their personality or not. They want to focus on the A+ setups and do and trade what's in front of them, not what they want to be in front of them. And traders, what they do, the professionals, they sometimes get mad because they didn't make more, whether they didn't stick to their plan, or whether they didn't follow the right trade, or whether they didn't, they just counted the money versus doing the right trade. You always have to do the right trade and not count the money, because if you count the money when you have a really good trade on, you're basically going to just take it off because you're doing the wrong thing. And finding the right setup and finding a trade that works is hard enough. So you want to make sure you make as much money as possible when it happens. How pros are different. Part two. I will tell you this: the few things that I've seen that set the pros apart is they have life balance. If you follow me on Twitter, you'll see on the weekend, I don't really talk about stocks as much. I talk about my Ragnar races. I talk about coaching my son's lacrosse or running with him, or even, going for a travel run with my dog. These are all things that pretty much burn off the stress of the week, that keep me balanced, because it's very important to have balance in your life. So this way you're happy and you can think clearly during the week. A bad week doesn't mean you should be down on yourself that weekend. You have to do things that get you happy, to keep you on the right page. I post a lot of different videos. Every weekend I watch a video, a few of them. I go on a run, I watch that video while we fall, and then I find all these little videos about athletes who have had injuries, athletes that have come back against all odds, all things, whether I had a good week or a bad week, to feed my brain. So you need that balance to feed your brain, to keep you positive, so you can think clearly and execute on your plan and follow your daily routine. You must have a daily routine, and you must like it. It's something you do every day. It's not glamorous. It's something you do every single day, so you're set up for your day. What happens when you have a great daily routine that you love? It gives you confidence in your strategy, and most of the pros have confidence in their strategies. You know what? We'll get a little bit more into this. There's a big power of simplicity. If you follow me on Twitter all the time on a Thursday or Friday, whenever it is, when we're at a key level, I'm like, let's simplify it. Use this level as your key. If we get below and stay below, yes, we can go lower. If we get below it and stay below it and then reclaim it, we get a red dog reversal, which are in all of my seminars. It teaches you how to execute on them. Or even if we're gonna go higher, if we get above the level and stay above the level, hey, we can go higher. That's simple. If we get above it and can't hold above it, we're not ready to go higher. I do not look at all this type of stuff. This is mayhem. This is just like bumble craziness, which tries to get traders to overthink whatever they're looking to do. And by the time they have one analytic confirm another analytic, the trade's already done. You're almost like you're looking excuses on why not to put on the trade. So for me, I think simplistic is better. Use your levels, use your trend, use your charts, use your tier system, have your go-to list. All concepts I go over in detail in all of my courses. I'm fine with, again, candlesticks, moving average, the trends, a set of specific chart patterns that I love, okay, because they repeat themselves, and I know what to look for. I know how to use my tier system based on a feeler, a tier 1, a tier 2, or tier 3, depending on what's happening, which I go over intensely. This is all I need to make money. I don't need to know what the MACD is doing, what the golden cross or the bear. Sometimes they're good and they help. They're coincidental indicators, but really I call myself a cocktail napkin technician because I keep it simplified, so this way I could execute and be in the moment when the moment's happening, and not look for 10 reasons to confirm the moment, because by the time you find your 10 reasons to confirm the moment, you're already chasing it, and the moment is behind you. The Bruce Lee approach. I fear not the man who has practiced 10,000 kicks once, but I fear the man who has practiced one kick 10,000 times. Now, if you really think about that, that's really, really deep. You don't want to be I always say all the time, I know a little about a lot, which I know fundamentals, I know the news, I know a little about all the things that, all the analysts and all the pundits and everyone's talking about, but I know a lot about what we do. And you need to know a lot about what we do, which is chart patterns, trend analysis, and tactics. Okay, everything else you need to know a little bit about. You need to know a little bit about what's happening with Brexit. You need to know a little bit about what the market's thinking about with the China trade deal. You need to know a little bit about, what the buzzword is. Like this week, it happens to be Boeing, and the market was actually strong while Boeing was down a pretty big percentage. So you knew the market was strong. So a little bit about that, but a lot about the levels and how the market reacts to all the noise around you. So don't feel pressure to learn everything under the sun. You need to have a broad-based scope of what's happening. Just know a lot about what it is you do. You can earn a living with a small handful of strategies. Some guys, all they do is look for the red dog reversal because it's calculated. It's, easy to scan, and you have to be very prudent and just waiting for it. And when it does, it's calculated, and you can make day trading money. And sometimes it's a new trend that lasts for 3 or 4 days. And we go into the red dog reversal very thoroughly in my path to profit strategy. And you don't even need to trade 40 stocks. My arsenal is like 20. I have a go-to list of 20. I probably trade 5 to 8 of those 20, and I rotate them in and out, and I go over how you create an A list, B list, and a C list as well, because that's really important. You want to be on the A list. You want to use the A list. The C and D list, it's just noise. And this this is a key. Everything is like, you feel like everything's a key, but everything is part of your practice and your puzzle. Discipline and patience, don't actually exist. They don't. Discipline and patience don't actually exist. The truth about traders are not naturally disciplined and patient. They just aren't. The people who come into trading are usually like these crazy athletes that were varsity athletes or went to D1 schools or thought they went to casinos and made a huge amount of money. So at first, they're not disciplined and they're not patient. They actually learn to be disciplined and patient because they took their school of hard knocks. I know for me, it's been a process to learn how to sit and wait. It's been a process to stay disciplined. It's been a process to use my stops. And all that happens through time. It happens through seat time. It happens through experience. It happens through looking at different types of markets in 20 years or taking courses to help advance that. Traders tend to be aggressive, impatient, and overly competitive. Okay, if you're competitive and you want to make the same amount of money the guy next to you is making and you're not ready, you know what? You're not going to be ready and you're going to lose. Okay, you want to make enough money to pay for a bigger mortgage, you know what? If your skill set's not there, you're going to lose. Traders tend to lose before they get disciplined and patient. There's a huge difference between your tendencies and what you actually do in the market. I'm not disciplined and I'm not patient by nature, but I follow a strategy that's made me successful. And I've learned how to be disciplined and patient by making mistakes and learning from them. Why traders rush into trades and break their own rules. If your strategy hasn't made you money in the past, you won't trust it in the failure or the future. You're almost destined to lose. So again, if your strategy hasn't made you money in the past, you won't trust it in the future. You're almost destined to lose. Traders that don't believe in their strategies break the rules. Discipline is simply doing what your plan says. There are so many traders around me that I'll be on a desk and I'll say, hey guys, what are you looking at? Oh, I'm looking at Apple to break above, what was it this week? Oh, I'm looking for Apple to break above 176. If Apple holds 176, maybe I'll add through 177.75. That's what their plan said. That's what my plan said in Apple this week. I don't know if you guys trade Apple, but that was my plan. All of a sudden, Apple gaps into 176, trades through 177.75, closes at 179. I say, hey guys, how'd you do? That was a great plan. Did you make money? No. Why? Oh, I went to Amazon, Facebook, and Netflix. I didn't trade Apple, but you said Apple was part of your plan. It was your A play. Somebody said something. I got taken off, and it happened too fast. Anyway, the discipline in using your plan and sticking to your plan is what's going to make you money. So sometimes the best way to stick to your plan is writing it down. Write down your plan so this way you are bound to it. Forget about how you feel. Focus on what strategy says to do what's next, not just a feeling. And sometimes you have to forget about the perfect entry. Not everything's going to work out exactly the way we want it, so you have to go with the flow. There is no such thing as a perfect entry chart or signal. You will never find one. Again, just talking about that Apple trade that happened this week. Basically on Friday, if you remember, which was the low, Apple was like one of the first ones to go green. A perfect entry would have been, hey, I wish Apple will open down on Monday because it was so strong Friday, I'm going to buy it. Instead, it gapped up at 176. So you didn't have the perfect setup, the perfect entry. You had to go after it fast because your system told you it gets above 176. The next thing's 177 and a quarter. Again, I don't want to just use this as an example, but I know a lot of you guys trade that. But you have to go with it. It's never going to be perfect. And if you try and be perfect, you're never going to trade. And if you never trade, you're never going to be able to make money. But you also want to make sure you just don't chase things. It's the system that gives you an edge, guys. I think it's the Trader Expo this week, and I presented at Trader Expos. Presented for Schwab. I presented for you name it. You saw it in the beginning of the webinar. I've seen so many different people that are looking for the perfect scenario, like the holy grail of making money, the best chart pattern, the best software, the best trade tools. It's not any of that. It's your system, it's your process, it's your routine, it's all the things that make up who you are that gives you your edge. And then you have to think clearly enough so you could use your edge so you can execute when chart patterns trigger. And so this way you could execute on your tier system and manage your trades and not chase and not psychologically get thrown out of what you were looking to do. If you wait forever for a trading signal, you're never going to make money. You looked at that slide a few slides ago. There could be 15 different indicators people are looking for before they put on a trade. By the time they get all their indicators, it's already done. All you need is a few. There was a smart guy out there one time who used to say to me, um, if it's intraday and the futures go down and your stock doesn't go down, it's good. Futures go up, you could buy it. If the futures are going up and the market's going up and your stock doesn't go up, it's not good. You sell it. So it's either good or bad. That's one indicator. Sometimes that's better than 10 other sophisticated, indicators. So again, stock market, if futures are going up, market's going up, your stock doesn't, you know what? Look to get short. Market's going down, it's going down for an hour, your stock doesn't go down, you look to get long. That's very simplified, but then you combine that with a tier system, chart patterns, and a trend, it can make you a heck of a lot of money. And the key is being on the right side of that trend, and then most of your work is done. The trend isn't your friend. Did you ever hear that? The trend isn't your friend? You know what it is? It's actually everything. The trend is everything. And you actually need to know which trend you're following. Are you following the active trend, the momentum trend, the intermediate trend, or the long-term trend, which all are things I go over in my courses. But you need to know which one of those is where you live. I actually live in the active trend. The active trend is when things are moving fast, when stocks are acting special, key stocks are making all-time highs, the market is strong. That's when I'm in a lot of positions in my portfolio approach, which we also go over. If the market's trending higher, you can make money long, even kind of on imperfect setups. It's, same is true on the short side. If you're short and you're in a bearish trend, you know what, you might be able to not have great entries and make money and work your way out of it. And you could also spot reversals. You'll do even better. This is the best of both worlds. Ride the trend and then pivot on the reversal. And you don't have to look for the reversal, but if you see it, you don't have to all of a sudden switch huge gears, but you need to notice it. I've ridden many trends where I'm holding like 6 to 12 stocks in a portfolio approach. All of a sudden I see a reversal. I go from 12 stocks to 3 stocks, and then I see a confirmation of the reversal. I get to flat, and then maybe I get short, and then I'm out of the way and I can embrace volatility. Same way on the downside. We've been in downtrends. We were in a huge downtrend heading into Christmas Eve, if you remember that. And then on 12/26, we reversed that trend. Okay, 23.51 was that level. In the S&P cash, we reclaimed that with red dog reversal. I went over that many times. And then from there, the trend changed. And I went from flat to 4 or 6 positions. And then on, remember January 4th, when Powell pivoted and he went to I'm not even looking at anything. I just remember these dates because they're so apparent. When he went dovish from hiking, and then that was when we started a whole new trend. You didn't have to catch the bottom at 23.51. You could have got long at 24.92, and boom, here we are above 2800. Anyway, at this point, little reversals are good to acknowledge, but they need confirmation. Even last week, we had a little bit of a reversal. If you remember, we went above 28.13 and failed. But what do? We held higher last Friday, and then we've seen commitment to that this entire week. These are all things you need to learn, and these are all tactics that I teach. What happens when you get the trend wrong? Basically everything. If you buy something and you're in a downtrend, you can get hurt. If you short something in an uptrend, chances are you're not going to be able to get out of it. The bad stocks you go short go to the moon. The blue chips you bought could still collapse. And if you buy something against a downtrend, yes, maybe you'll lose a little less, but it's still going to hurt you. So you need to know what trend you're in. You need to know how to follow the trend and how to read what kind of trend you're in. All things that are very important and imperative. Not to mention what can happen to your long-term retirement funds. What's kept me in the business after 20 plus years? Think to yourself right now, how many years have I been trading? Have I been trading 1 year? Have I been trading 2 years? Has it been 8 years? Have some of you might have even been trading as long as I have. Okay, and obviously you all have had a system to keep you in the business, and you've all had a process to to keep you profitable. But I'm going to let you know a little bit about what has kept me in this business for 20 years, and I'm hoping I could stay in this business for another 10 or 15. What am I? I'm 46. I could probably stay until I'm 60. What do you think? Uh, Maybe more. Like I think I could write my note. I could be like who's that guy? Byron Ween. I think I could write and stay with it. Just maybe instead of high beta tech stocks, I have to bring it a little bit more less risky so I don't have a heart attack. But anyway, you won't have a heart attack if you have a process. And what I've done to keep me in this business for 20 years is I fell in love with a process. Let me say it again. I am not patient or disciplined person, but I built a strategy I believe in and I don't break it. Every day I'm up at 4:45. Every day I'm checking the futures and tweeting it to Redler Ultimate Access to let them know what the feel of the overnight markets are. Then I'm on a 6 o'clock ferry. Then I'm in the office at 6:30. I'm writing my note. My note's got 7 different sectors, 20 different names. I write a whole active plan on. Every day while doing this, I'm drinking my coffee, I'm listening to music, and I'm relaxing. So I'm basically doing a process that I do every day and that I love. Like when you do that, or you could definitely do it over time. If you have a process and a routine you don't love, you're forcing it, you're never going to do it. When you trade to pay the bills, you can't afford to not succeed. Okay, you know what that means? Meaning, you know what? If you had a great year and all of a sudden you bought a house because you said, hey, I had an awesome year, I'm going to have this awesome year again, or I'm going to make even more money, and then all of a sudden you're trading to make that money versus what the market's in front of you, chances are you're not going to make enough to pay for the big mortgage, and then all of a sudden you're going to force trades, and then you're going to get heady, and then you're not going to stay in the business. So what I've done is I built a process and I keep it even keeled. So that makes me patient, keeps me disciplined, so I don't have to force trades to pay the bills, because then I wouldn't succeed. I found what works for me, and I'm not going to change as long as I'm getting results. Yes, I work on my process. Everyone knows I'm not a great short. But you know what? If there's a great short setup, I put some on. Do I put on as much in a short setup as I would if I loved the long setup? Probably not. But you know what? I do a little bit of each. And chances are being out of the way and being in cash when the markets are short, you know what? That's half the battle. But you have to learn how to read when that is, and that's what I do in all my courses. I teach you about all the different types of trends and how the market's doing. You can't change who you are, but you could change how you approach the market. So say that again. You can't change who you are. You can change a little bit. Listen, they can't say teach an old dog, I'm the red dog, an old dog, new tricks. You could teach them a little bit. You could always change it a little bit, but your psyche's your psyche. But you can't really take your likes and dislikes into the market. Like some say, hey, I hate hamburgers, so I can't buy McDonald's. Or hey, Mexican food makes me go to the bathroom, so Chipotle stock is not for me. You can't take your likes and dislikes into the market. You know, what you could do is you could take your approach into the market, and you could change it and tweak it. You make money by doing, not by feeling, not by hoping, and not by wishing. Say that again. You make money by doing, and following your process, not by a feeling. Sometimes as a trader, I get a feeling. My little trader sense will say, hey, I think this feels like it's going up, but it's only a feeling until the market confirms it. Again, your idea is an idea. It's not a strategy until the market confirms it. And if all of a sudden you're hoping, for the market to confirm and it's going against you, that's not going to make you money. If you're wishing a trade's going to go up and it's not going up when the futures are going up, when the market's going up, you better take notice and get out pretty darn fast, because you're wrong. And the quicker you admit that you're wrong, the less money you're going to lose, and you'll get what I call a paper cut versus a gusher. And little paper cuts do add up sometimes, but then when you're on the right side, they're much easier to make up than gushers. You can't magically give yourself the right mindset. Follow a strategy you believe in, and then only will you improve your mindset and your P&L. So once you believe in your strategy and find success, and you start to build on it, what could you do? You can increase your share size. You could increase the amount of positions you have on, and then you increase your P&L. But you'll only believe in your strategy when you find consistent success, not by being a thrill seeker, not by throwing things against a wall, not by guessing at the earnings, but by having a sound strategy, using moving averages, using the trend, using chart patterns, using a tier system, using discipline and stops. All things that you need to know with a lot of X's and O's in order to incorporate into your strategy. 4 things you can improve on right now. Okay, these are the things that I think right now, without anything else you could think about and improve on, is treat trading like a business, not a hobby. Focus on it. Ignore the news and listen to the charts. Meaning, if everyone's saying the world's going to end with Brexit or with Trump being the president, you look to see how the market reacts to it. You look at the moving averages, you look at the charts, look at the trends, and that's how you figure it out. You turn out the noise. Obsess over the trend instead of the end, meaning don't try and think about when the trend is over. When we're in the 7th year of this bull market from 2009, all I heard is we're in the 7th year, it's got to end. Oh, we're in the 8th year, it's got to end. Now we're in the 10th year of this bull run from the 2009 lows with some minor corrections in it. But I always say look for the setup, not for a top. So if you look for a setup instead of the top and trying to be small with the big call, which we said big calls don't make you money, it's your process that does, that's much better. Focus on learning a strategy, not 100,000 of them. Focus on a few. Same way you don't need 40 stocks. Focus on your go-to list. I always have a go-to list in my morning note every single day. I have a go-to list of 20 names, and sometimes 5 or 6 change because of the way they act. But those are the ones that I watch, I think are technically sound by using my technical rules, by using my process and my system, and that's what I follow. So I have confidence on executing on them. These are 4 things right now I do believe you can improve on just by listening to what we just went over. But now what you really have to do is you have to figure out your process by learning tactics. Tactics, not just strategies. I mean like tactics, I mean like X's and O's, not just mindset. The mindset is key, but in order to have the right mindset, you need to have the right tools and process to use. And with that, you need to know how to read a short-term trend. You need to know how to read chart patterns. You need to know how to maneuver your tier system, and you need to know what type of approach you need to be in depending on the market. And those are all things that I teach